Hello and welcome to Chapter 10 of FIN552, the Capital Asset Pricing Model, which everyone simply calls the CAPM. This is one of the most famous and useful ideas in all of finance, and it answers a question every investor asks: how much return should I demand for taking on a given amount of risk? In the last chapters, we learned about diversification and managing portfolios. Now we put a precise price on risk itself. By the end of this chapter, you will understand the single most important formula in investment. You will be able to draw and read two key graphs called the capital market line and the security market line, and you will be able to decide whether a share is fairly priced, a bargain, or a trap using a number called alpha. The whole chapter builds from one simple idea, that fair return rises in a straight line with risk. As always, I define every term as it appears and assume no prior knowledge. Let us begin with a question. Let me start with a very practical question. Imagine two shares, and both look attractive, but one of them is far riskier than the other. Common sense says you should demand a higher return for taking on the riskier one. But how much higher exactly? Should it be 1% more, 5% more, 10%? This is not a vague matter of opinion. The CAPM gives a precise, calculable answer, and four ideas build up to it, shown on the cards. The first idea is understanding what kind of risk actually matters, because risk splits into two types: systematic or market-wide risk and unsystematic or company-specific risk. The second idea is the price of risk itself, captured in the famous CAPM formula that links a security's risk to its fair expected return. The third idea is two important lines, the capital market line and the security market line, which draw the relationship between risk and return as graphs. And the fourth idea is the payoff, using CAPM to reveal whether a share is overvalued or undervalued, and to measure its alpha, the return above what is fair. Keep these four cards in mind. They are the journey of the whole chapter. First, let us see who relies on CAPM in the real world. Before we dive into theory, let me show you that the CAPM is not just an academic exercise. It is used every single day by serious institutions to set what they call the required return. Look at the first column, Malaysian institutions. The EPF, our giant retirement fund, and KDOWAP, the civil service pension fund, use a required rate of return, calculated with CAPM, to judge whether a new investment is worth making. Bursa analysts at houses like Kenanga and Affin Hwang use it to test whether a stock is fairly priced, and Bank Negara and fund managers use a number called beta to price risk in local portfolios. In the middle column, global asset managers. The biggest names in the world, BlackRock and Fidelity, estimate the cost of capital using CAPM as a matter of daily routine. Investment banks use a CAPM expected return to help price new share offerings, or IPOs. And hedge funds are constantly hunting for positive alpha, which means beating the CAPM benchmark. In the third column, corporate finance. Ordinary companies use CAPM to find the discount rate for evaluating new projects. Chief financial officers compare a project's expected return against its CAPM required return to decide whether to go ahead. So CAPM is the bridge that links the stock market's pricing of risk to real business decisions. The takeaway: CAPM answers the one question everyone in finance asks: what return is fair for this much risk? Let us now state precisely what you will be able to do by the end of this chapter. Here are our 5 learning outcomes, each tagged with a Bloom's taxonomy level from C1 to C5. The first, A remember level outcome is to define the CAPM and to distinguish systematic from unsystematic risk, the two types we just mentioned. The second, an understand level outcome, is to explain the assumptions behind the model and the central role of something called the market portfolio. The third, and this is an apply level outcome that brings calculation, is to use the CAPM formula to compute a security's required return, the single most important sum in the chapter. The fourth, also apply level, is to construct and interpret the two graphs, the capital market line and the security market line. And the fifth, an analyze level outcome, is to analyze whether securities are overvalued or undervalued using alpha. Notice the exam tip in the gold box. Outcomes 3 and 4 are the apply level ones, so that is where your calculations will come from. The CAPM required return, the capital market line, and alpha. Let me show you the roadmap for the chapter. Here is the map for our journey. 5 clear stops that build from pure theory to practical stock picking. Stop 1 is capital market theory, where we meet the big idea behind CAPM and the two types of risk. Stop 2 is the CAPM formula itself, the heart of the chapter, which we will learn by heart and practice. Stop 3 is the capital market line, the first of our two graphs, which prices diversified portfolios by their total risk. Stop 4 is the security market line, the second graph, which prices individual securities by their beta. And stop 5 is the payoff, valuation and alpha, where we use all of this to decide whether real stocks are bargains or traps. Notice the logic. We build from theory, asking what is risk worth, all the way to practice, asking is this particular stock cheap or expensive. Let us begin at stop 1. Welcome to section 1, Capital Market Theory and the CAPM itself. Here we lay the foundations. We will see where the model came from. We will learn the crucial distinction between the two types of risk, and then we will meet the famous formula and practice it on a real Bursa stock. We will finish by looking honestly at the simplifying assumptions the model rests on. Let us start by asking, what exactly is the CAPM? So, what is the CAPM? Let me give you the plain idea first. In the blue box, the CAPM tells you the fair return you should expect from an investment, given only one thing, how much market risk it carries. That is its whole purpose, to turn a level of risk into a fair return. Now, the formal definition, the capital asset pricing model, developed by the economist William Sharpe in 1970, describes the linear relationship between a security's systematic risk and its expected return. The word linear is important. It means the relationship is a straight line, simple and predictable. 3 features in the cards deepen the idea. First, CAPM extends the work of Markowitz, who you may have met, by adding a risk-free asset, like a government bill, to his efficient frontier of risky portfolios. Second, in CAPM, a stock's expected return should equal its cost of capital. The return investors require to be willing to hold it. And third, crucially, risk is priced by beta, because only market or systematic risk is rewarded, and beta is the number that measures that risk. The takeaway, the CAPM converts the question how risky is it into the question what return is fair, using one simple linear relationship. But to understand why only some risk is rewarded, we must first separate the two types of risk. To understand CAPM, you must first understand that not all risk is the same. Risk splits into two fundamentally different types, and the difference is the key to the whole model. The first type, on the top left, is systematic risk. This is market-wide risk that affects everything at once. things like rising interest rates, a recession, or a war. The crucial property of systematic risk is that it cannot be diversified away. No matter how many different shares you own, when the whole market crashes, your portfolio crashes with it, so every investor must bear this risk. The second type, on the bottom left, is unsystematic risk, also called company-specific risk. This is risk unique to one company, such as a workers' strike, a product recall, or a lawsuit. And here is the good news. Unsystematic risk can be diversified away simply by holding many different stocks, because a disaster at one company is cancelled out by good news at another. Look at the chart on the right, which shows this beautifully. As you add more stocks to a portfolio, moving right along the bottom, the total risk falls steeply at first. That falling part is the unsystematic risk being diversified away, shaded green. But the risk does not fall to zero. It flattens out at a floor, the gold dashed line, and that floor is the systematic risk that can never be removed. Now here is the punchline of the whole chapter. And the takeaway, since investors can easily erase company-specific risk for free through diversification, the market does not reward it. Only the undiversifiable systematic risk earns a reward. That is why CAPM prices risk using beta, which measures systematic risk alone. Let us now meet the formula. This is the heart of the entire chapter, the CAPM formula, and I want you to learn it by heart because almost every calculation flows from it. Read it slowly. The required return on a security, R sub I, equals the risk-free rate, R sub F, plus beta, the Greek letter beta, with subscript I, multiplied by, in brackets, the market return R sub M minus the risk-free rate R sub F. Let me define each piece shown in the four cards. R sub I is what we are usually solving for. The expected or required return on security I, the fair return. R sub F is the risk-free rate, the return on a totally safe asset like a Malaysian treasury bill, your reward for simply waiting. Beta sub I is the star of the show. It measures how much market risk the security carries, how sensitive it is to the market's ups and downs. And the bracket, R sub M minus R sub F, is the market risk premium, the extra return investors get for bearing the market's risk, which we will study on the next slide. Put it in words, and you have the takeaway. The required return equals the risk-free rate plus beta times the market risk premium. The intuition is beautiful. You start with the safe return, then add a risk premium that is scaled up or down by beta. So a higher beta, meaning more risk, gives a higher required return. Let us look more closely at that market risk premium. Let us zoom in on one piece of the CAPM formula, the market risk premium, because it is both important and intuitive. The market risk premium is the extra return that investors demand from the market portfolio over and above the safe risk-free rate. Its formula, on the left, is simply the market return R sub M minus the risk-free rate R sub F. Now here is the lovely intuition. The market risk premium is really a measure of how fearful or how relaxed investors are, their aversion to risk. When markets are nervous, during a credit crisis or an oil shock, investors become frightened and demand a higher premium to be tempted into risky shares at all. When markets are calm and confident, they are content with a lower premium. So the premium breeds with the mood of the market. Let me make it concrete with the Malaysian example on the right. Suppose the FBM KLCI, our market index, is expected to return 11%, while Malaysian treasury bills, the safe asset, pay 3.5%. Then the market risk premium is 11% minus 3.5%, which equals 7.5%. And what does that 7.5% mean? It is precisely the reward an investor earns for choosing to hold the risky market instead of parking their money in safe bills. The takeaway, the market risk premium equals R sub M minus R sub F, and it rises when investors are fearful and falls when they are calm. Now let us put the whole CAPM formula to work in a proper worked example. Now let us put the CAPM formula to work in a complete exam-style example featuring Mr. Hafiz. He is looking at a Bursa stock with a beta of 1.2. Malaysian Treasury bills, the risk-free asset, pay 6% and the market is expected to return 15%. The question is, what return should Mr. Hafiz require from this stock to be fairly compensated for its risk? Step 1. Write the formula. The required return R sub I equals the risk-free rate R sub F plus beta times the bracket of market return minus risk-free rate. Step 2. Substitute the numbers and solve, showing every line. The risk-free rate is 6%, beta is 1.2. The bracket 15% minus 6% equals 9%, which is the market risk premium. So we have 6% plus 1.2 times 9%. 1.2 times 9% is 10.8%. Adding the 6% risk-free rate gives 16.8%. So the answer in the gold box is that Mr. Hafiz should require a return of 16.8%. And here is the practical meaning. In the takeaway, 16.8% is the fair return for this stock's level of risk. So if the stock is only offering, say 14%, then it is not paying Mr. Hafiz enough for the risk he would be taking, and he should not buy it. We will turn this exact comparison into a buy or sell rule later. First, let us be honest about the assumptions CAPM relies on. Every model is a simplification of reality, and the CAPM is no exception. To produce its clean, elegant result, it assumes a rather idealized world, and you should know what that world looks like, because the assumptions are a favorite exam topic. There are 8 of them shown on the cards. First, investors are risk-averse. Everyone dislikes risk and follows Markowitz by choosing efficient portfolios. Second, investors can borrow and lend freely at the risk-free rate as much as they like. Third, they are rational optimizers, all using the same mean variance method to build portfolios. Fourth, they hold well-diversified portfolios, so all the company-specific risk has been removed. Fifth, everyone has the same single time horizon, planning over the same period. Sixth, the market is frictionless, with no taxes and no transaction costs anywhere. Seventh, investors have homogeneous beliefs, meaning they all share the same expectations about future outcomes. And eighth, there is no inflation to distort returns. Now, you have probably already noticed that not one of these assumptions is fully true in the real world. There are always taxes, costs, and disagreements. So why bother? The takeaway answers that these assumptions are indeed unrealistic, but they are what allow us to build a clean, powerful, and genuinely useful model of fair pricing. A simplified map is still far better than no map at all. Let us see what these assumptions lead to and why the result matters. So what do all those assumptions actually lead to, and why should anyone care? On the left is the resulting equilibrium, the state the market settles into. The remarkable conclusion is that all investors end up holding exactly the same risky portfolio, which we call the market portfolio, labeled M. This market portfolio contains every security in the market, each weighted by its share of the total market value. So bigger companies make up a bigger slice. and the market's overall risk premium depends on the average risk aversion of all investors taken together. The more fearful the crowd, the higher the premium, as we saw. This is a powerful and surprising idea that in theory, everyone should hold the same diversified market portfolio. On the right is why CAPM matters in practice. 3 concrete uses. First, it gives us a benchmark return for judging any possible investment, a yardstick for fair. Second, it identifies mispricing by letting us ask whether a forecast return is above or below the fair level, which is the basis of finding bargains. And third, it can estimate the fair return for assets that have not even been traded yet, which is exactly how a bank prices a new share offering, an IPO. The takeaway, in equilibrium, everyone holds the market portfolio, and CAPM becomes the universal yardstick for fair return. That market portfolio M is the key that unlocks our first graph, the capital market line, which is section 2. Section 2 introduces the first of our 2 famous graphs, the capital market line, or CML. The idea is elegant. Markowitz gave us a curved frontier of the best risky portfolios. But what happens when we also allow investors to hold a safe, risk-free asset and mix it with the market portfolio? A remarkable thing, the curved frontier is replaced by a single straight line, the CML, that is superior to everything below it. In this section, we will define the line, dissect its slope and axis, calculate a portfolio's return with it, and meet the elegant separation theorem. Let us begin. So what exactly is the capital market line? The plain idea, in the blue box, is that the CML shows the best possible return you can earn for each level of total risk, once you are allowed to mix the market portfolio with a risk-free asset. The formal definition is short. The CML is the line of efficient portfolios that combine the risk-free asset and the market portfolio. 3 features in the cards explain why it matters. First, it is a new and better efficient frontier. Markowitz's frontier of risky assets was a curve. But once you add risk-free lending and borrowing, the best you can do is a straight line that touches that curve at the market portfolio and rises above everything else, so it is superior. Second, along this line, both risk and return rise in a straight line, beautifully simple and linear. Third, and this is the punchline, every rational investor will choose some point on this single line, because any portfolio below the line gives less return for the same risk and is therefore inferior. The takeaway, the CML is the menu of the best portfolios available, and every smart investor picks a point somewhere on this one line. Let us now dissect the anatomy of that line, its slope and its axis. Let us read the anatomy of the capital market line piece by piece, with the graph on the right to guide us. Start with the axis. The vertical, or y-axis, shows the expected return, E of R, the return of a portfolio. The horizontal, or x-axis, shows the total risk, measured by sigma, the standard deviation of the portfolio. So as you move right, risk increases, and as you move up, return increases. Now the line itself. Where does it start? At the y-intercept, which is the risk-free red R sub f, sitting at 0 risk on the left, because a totally safe asset has no risk but still earns the risk-free return. From there, the line rises steadily, and the steepness of that rise, the slope, is the single most important feature. The slope formula, on the left, is the market return minus the risk-free rate, all divided by the market standard deviation, sigma m. This slope has a beautiful name, the market price of risk. It tells you exactly how much extra return you earn for each additional unit of risk you take on. A steep CML means risk is well rewarded. A shallow one means it is not. On the graph, you can also see the market portfolio M sitting on the line with lending portfolios to its lower left, where you mix in some safe asset, and borrowing portfolios to its upper right. The takeaway: the CML slope is the market price of risk, how much extra return each unit of risk earns. Let us now turn that slope into a usable equation. Now let us turn the capital market line into an equation we can actually compute with. The CML equation in the navy box says that the expected return of a portfolio, E of R sub P, equals the risk-free rate R sub F plus a fraction times sigma P. That fraction is the slope we just met, the market return minus the risk-free rate over the market standard deviation sigma M, and we multiply it by sigma P, the portfolio's own standard deviation, its total risk. In plain words, and this is the intuition, a diversified portfolio's return equals the safe risk-free rate plus a risk premium that grows in proportion to how much risk sigma P the portfolio takes. Let me work the example featuring Puan Aisha. Her figures are: the risk-free rate is 4%, the expected market return is 12%, the market standard deviation sigma M is 18%, and her own portfolio's standard deviation sigma P is 9%. Substitute into the formula. The slope is 12% minus 4%, which is 8%, divided by 18%. We then multiply that by her 9%. Notice that 9 over 18 is 1/2, so 8% times 1/2 is 4%. Adding the 4% risk-free rate gives 8%, so her portfolio's fair return is 8.0%, shown in the gold box. And it makes sense, her portfolio carries exactly half the market's risk, so she earns the risk-free rate plus half of the market's risk premium. The takeaway: on the CML, more portfolio risk buys more return, priced at the market's price of risk. Next, how do investors actually choose their spot on the line? Through lending and borrowing. We have said every investor picks a point on the capital market line, but how do they actually get to different points if everyone holds the same market portfolio M? The answer is through lending and borrowing, and it leads to one of the most elegant ideas in finance. Look at the three positions. In the middle is the market portfolio M, where you hold 100% of your money in the market portfolio, the single risky portfolio that anyone needs. To its left is a lending portfolio labeled L. Here you put only part of your money in the market portfolio M and lend the rest at the risk-free rate. In other words, you keep some cash in safe bills. This gives you lower risk and lower return, perfect for a cautious investor. To the right is a borrowing portfolio labeled N. Here you are so keen on returns that you actually borrow money at the risk-free rate and invest more than 100% of your own money in the market portfolio. This gives you higher risk and higher return. Now here is the elegant conclusion, the separation theorem, in the box at the bottom. It says that the investment decision, which risky portfolio to hold, and the answer is always M, is completely separate from the financing decision, how much to lend or borrow. So everyone, the cautious retiree and the aggressive young investor, holds the very same market portfolio M, and the only thing that differs between them is how much cash they mix in or borrow. The takeaway: everyone holds the same market portfolio M, and your personal risk choice is simply how much you lend or borrow. Let us make that concrete for you as an investor. Let us make the separation theorem personal. Where exactly should you sit on the capital market line? It depends entirely on your appetite for risk. and there are two broad types of investor. On the left is the conservative investor. This person sits near the lower left of the CML. They lend some of their money at the safe risk-free rate and hold less of the risky market portfolio. The result is lower risk with steadier but smaller returns. Think of a retiree like Puan Aisha, who cannot afford big losses and values stability above all. On the right is the growth-oriented investor. This person sits near or even beyond the market portfolio M. The most aggressive of them may even borrow money to invest more than 100% in the market. The result is higher risk but a higher expected return. Think of a young investor like Mr. Hafiz, who has a long time to recover from any losses and wants his money to grow. Notice the crucial point that ties back to the separation theorem. Both of them hold the very same market portfolio M, neither one picks different individual stocks. The only difference is how far along the line they sit, set by how much they lend or borrow. The takeaway: the same market portfolio serves everyone, and you simply slide along the CML to match your own appetite for risk. That completes the capital market line. But the CML only prices whole diversified portfolios by their total risk. To price individual stocks, we need the second line, the security market line, which is Section 3. Section 3 is where everything comes together and becomes genuinely useful for picking stocks. The capital market line was wonderful, but it only prices whole, perfectly diversified portfolios using total risk. Most of the time, though, we want to value a single share. For that, we need the second line, the security market line, which prices any individual security using beta, its systematic risk. And once we can find a security's fair return, we can compare it with the actual return to decide whether the stock is a bargain or a trap, and to measure its alpha. We will finish with a full 4-stock worked example and an honest look at the model's limits. Let us begin. So what is the security market line, the SML? The simplest way to understand it, in the blue box, is that the SML is just the CAPM formula drawn as a graph. It plots each security's required return against its beta. The formal definition, a graphical representation of the CAPM showing required return as a linear function of beta. 3 features distinguish it on the left, and look at the graph on the right as I explain. First, and this is the key difference from the CML, the horizontal axis is beta, not sigma. So the SML measures risk by beta, which is systematic risk only, the kind that actually gets rewarded. Second, it works for any security. Every individual stock and every portfolio should lie on this line if it is fairly priced. Third, it is linear. Higher beta means higher required return, rising in a straight line from the risk-free rate. On the graph, you can see the SML rising from R sub F and several stocks plotted as dots, some sitting above the line and some below, which is exactly what we will use to spot bargains shortly. The takeaway captures the crucial contrast. The CML uses total risk, sigma, and only works for efficient portfolios, whereas the SML uses beta and works for every single security. Let us look at the SML equation and where beta comes from. Let us look at the SML equation, and importantly, where beta actually comes from. The first thing to notice on the left is wonderfully simple. The SML equation is literally the CAPM formula we already learned. The required return equals the risk-free rate plus beta times the market risk premium. So you do not need to learn a new equation for the SML. It is the CAPM. But where does beta itself come from? Its definition is on the right. Beta equals the covariance of the security with the market divided by the variance of the market, sigma m squared. Covariance is just a measure of how two things move together, and that can be rewritten, since covariance equals the correlation R times the two standard deviations, as the correlation between the stock and the market, times the stock's standard deviation, times the market's all over the market's variance. Do not be intimidated. In exams, beta is usually given to you, but you should recognize that beta measures how strongly a stock co-moves with the market. Now, the three cases of beta in the cards, and these are essential. If beta equals 1, the stock moves exactly with the market, like the index itself. If beta is greater than 1, the stock is more volatile than the market, an aggressive, higher risk stock that swings more than the market does. If beta is less than 1, the stock is less volatile than the market, a defensive, lower risk stock. The takeaway: beta scales the market premium. A beta of 1 matches the market, above 1 is riskier, and below 1 is safer. Now let us carefully compare the two lines, the CML and the SML, because students often confuse them. Because students so often confuse the capital market line and the security market line, let us compare them carefully, side by side. They look similar. Both are upward sloping straight lines relating risk to return, but they measure risk very differently. Read down the table. The y-axis is similar for both. Expected return, though the CMLs is the return of a portfolio and the SMLs is the return of a security. The real difference is the x-axis. The CML's horizontal axis is the standard deviation, sigma, which is total risk. The SML's horizontal axis is beta, which is systematic risk only. That is the single most important distinction. Their slopes differ too. The CML's slope is the market premium divided by sigma m, the market price of risk per unit of total risk. The SML's slope is simply the market premium itself. Next, what lies on each line? Only efficient, perfectly diversified portfolios lie on the CML, combinations of the market and the risk-free asset. But every security and every portfolio, fairly priced, should lie on the SML. And finally, what each measures: the CML measures total risk, while the SML measures systematic risk only. The key difference in the box is worth memorizing. The CML uses sigma and fits only efficient portfolios, while the SML uses beta and fits every single security. Because the SML works for individual stocks, it is the tool we use to spot bargains, which we turn to now. Now we reach the practical payoff of the whole chapter, using the security market line to spot bargains and traps. The principle in the blue box is simple and powerful. If a stock is fairly priced, it sits exactly on the SML, earning precisely the return that CAPM says its risk deserves. But if a stock sits off the line, the market has mispriced it, and that is your opportunity. There are two cases. On the left, undervalued, which means the stock sits above the SML. Here, the stock's actual return is higher than the CAPM required return. In other words, you are being paid more than is fair for the risk. That is a desirable, cheap asset, a bargain. So the rule is buy it. On the right, overvalued, which means the stock sits below the SML. Here, the actual return is lower than CAPM requires. You are being paid less than is fair for the risk. The stock is too expensive. So the rule is sell it or avoid it. The mental picture is simple. The SML is the line of fair value. Anything floating above it is a bargain, and anything sinking below it is overpriced. The takeaway: above the SML means undervalued, so buy, and below the SML means overvalued, so sell, with the line itself representing fair value. Let us put these rules into a precise decision table. Let us turn the buy and sell idea into a precise decision table you can apply mechanically in an exam. Everything hinges on one comparison, the CAPM required return versus the stock's actual return. Read the three rows. First row, undervalued. This is when the CAPM required return is less than the actual return, meaning the stock pays more than it should for its risk. For a potential investor who does not yet own it, the action is buy the security. For an existing investor who already holds it, the action is hold and maintain it. Do not sell a bargain. Second row, overvalued. This is when the CAPM required return is greater than the actual return. The stock pays less than it should. For a potential investor, do not buy it. For an existing investor, sell the security, get out of an overpriced holding. Third row, properly valued. This is when the KIPM required return equals the actual return exactly. The stock is fairly priced and sits on the SML. A potential investor is indifferent and an existing investor simply holds because it is fair. The takeaway in the box distills it to one comparison. Place KIPM's required return next to the actual return. If actual beats CAPM, the stock is a bargain to buy or hold, and if actual falls short, it is overpriced to avoid or sell. The size of the gap between the two has its own name, alpha, which we meet next. We have been talking about the gap between a stock's actual return and the fair CAPM return. That gap has a famous name, alpha, written with the Greek letter that looks like a fish. Alpha is the gap between a stock's actual return and the return that CAPM says it should earn for its risk. The formula on the left is beautifully simple. Alpha equals the actual return minus the expected, that is the CAPM return. There are two cases. A positive alpha plus alpha means the stock beat its KPM benchmark, it earned more than its risk deserved, a good positive abnormal return. A negative alpha minus alpha means the stock fell short of its benchmark, it underperformed for its risk, which is bad. Let me show the quick example on the right. Suppose a stock's CAPM required return is 12%, but it actually returns 15%. Then its alpha is 15 minus 12, which is plus 3%. That positive 3% means the stock or the fund manager who picked it added 3% of value beyond what the risk alone would justify. And this is precisely what every active manager is chasing. Positive alpha is, as we say, the holy grail of active management because it is proof of genuine skill rather than just taking more risk. The takeaway, alpha equals actual minus KPM expected return, and positive alpha is the holy grail every active manager chases. Now let us bring the entire chapter together in a full worked example with 4 stocks. Let us bring the whole chapter together in a complete worked example with 4 stocks, A, B, C, and D. This is part 1, where we compute each stock's fair CAPM required return. The given information at the top is that the risk-free rate is 6%. The expected market return is 15%, so the market premium is 15 minus 6, which is 9%. We will use the formula required return equals 6% plus beta times 9% for each stock. The data table on the left gives each stock's beta and its actual return. Let us compute the CAPM return for each. For stock A, with a beta of 1.2, the required return is 6% plus 1.2 times 9%, which is 6 plus 10.8, giving 16.8%. For stock B, beta 0.7, 6 plus 0.7 times 9, which is 6 plus 6.3, giving 12.3%. For stock C, beta 1.5, 6 plus 1.5 times 9, which is 6 plus 13.5, giving 19.5%. And for stock D, beta 1.0, 6 plus 1 times 9, giving exactly 15%, the market return, which makes sense because a beta of 1 means it matches the market. The takeaway, just plug each beta into the formula 6 plus beta times 9. These 4 CAPM returns are the fair benchmarks. We will compare against the actual returns in part 2 to find each stock's alpha and decide whether to buy or sell. Now part 2, where we compare each stock's actual return against the fair CAPM return we just computed to find its alpha and reach a verdict. Read the table together with the alpha chart on the right. For stock A, the CAPM return is 16.8%, but it actually returns only 12%. So its alpha is 12 minus 16.8, which is minus 4.8%, a large negative alpha. Stock A is overvalued. It is paying you far too little for its high risk. It is the trap. For stock B, CAPM says 12.3%, and it actually returns 14%. Its alpha is plus 1.7% positive. So stock B is undervalued, a bargain to buy. For stock C, CAPM says 19.5% and it returns 20%, an alpha of plus 0.5%, also positive, so C is undervalued too, a smaller bargain. And for stock D, CAPM says 15% and it returns exactly 15%, an alpha of 0, so D is properly valued, sitting right on the SML, fair. The alpha chart on the right shows this at a glance. A's red bar plunging below 0, B and C's green bars above, and D at 0. The takeaway, actual above, CAPM, means positive alpha, means undervalued, means buy. Stock A is the trap to avoid, while B and C are the bargains to buy. This single example ties together everything in the chapter, the formula, the SML, valuation, and alpha. Before we finish, a word of honest caution about the model's limits. The CAPM is one of the great ideas in finance, but no honest course would leave you thinking it is perfect. So let us look at its real limitations. There are 4 main ones. First, betas are unstable. A stock's beta is not fixed. It changes over time as the company and the market change. So a beta measured from the past may badly misprice the stock's future risk. Second, CAPM ignores other factors. It rewards only one thing, market risk measured by beta. But decades of research have shown that other factors like company size and whether a stock is value or growth also affect returns, and CAPM simply ignores them. Third, past does not equal future. The whole model relies on historical prices and returns to estimate beta and the market premium. But history is not always a reliable guide to what comes next. And fourth, the results are benchmark sensitive, meaning your answers change depending on which market index you choose as the benchmark. The FBMKLCI will give a different beta than, say, a global index. The takeaway is balanced and important. KPM is a brilliant simplification, not a crystal ball, and its assumptions about beta and the benchmark can mislead if you trust them blindly. Use it as a powerful guide, not an infallible oracle. Let us now pull the entire chapter together on a single page. Here is the entire chapter on a single page, your revision map. At the top sits our subject, Chapter 10, the CAPM. Everything flows down into 3 pillars. The first pillar, Foundations, covers the distinction between systematic and unsystematic risk. The central CAPM formula, required return equals the risk-free rate plus beta times the market premium, and the assumptions that lead to everyone holding the market portfolio. The second pillar, the capital market line, covers combining the risk-free asset with the market portfolio, measuring risk by sigma, total risk, and the ideas of lending, borrowing, and the separation theorem. The third pillar, the SML and valuation, covers measuring risk by beta instead, judging stocks as over or undervalued, and computing their alpha, and the worked example with stocks A to D. And along the bottom, the single idea that ties the whole chapter together, fair return rises in a straight line with systematic risk. If you can explain all three pillars and perform the CAPM and alpha calculations, you have mastered this chapter. Let me close with a final word. And that brings us to the end of Chapter 10, the Capital Asset Pricing Model. You have learned how finance puts a precise price on risk. Questions are very welcome, so as I always say, let us price some risk together. Bring me anything that is unclear. Before you sit the exam, make sure you can do three things listed in the box. First, use the CAPM formula. Required return equals the risk-free rate plus beta times the market premium to find any securities required return. Second, tell the capital market line and the security market line apart, remembering that the CML uses sigma for portfolios and the SML uses beta for every security, and be able to read each graph. And third, compute alpha, the actual return minus the CAPM expected return, and use it to decide whether a stock is overvalued or undervalued, and therefore whether to buy or sell. Practice the Mr. Hafiz example and the 4-stock example until they are second nature. If you can do all of that, you are ready not just for the exam, but to think like a real analyst who knows exactly what return is fair for any level of risk. Thank you so much for your attention. Take care, and I will see you in the next chapter.